Welcome to our channel. In today's video, we'll be exploring a topic that touches the cornerstone of homeownership and finance: how switching banks before closing can impact your mortgage approval. It's an often overlooked aspect, yet it holds the potential to be a significant pitfall for many prospective homeowners. Join us as we delve into the intricacies of this important issue. Picture this: you're sailing smoothly through the process of acquiring your dream home. The financing is in place and your mortgage application has sailed through most of the approval stages. But then something as simple as switching your bank for the sake of convenience or benefits suddenly throws a wrench into the entire process. Let's explore why this seemingly minor decision can have major consequences. First, let's consider the bank's perspective. Banks place enormous emphasis on stability. They rely on the financial habits and history of applicants to assess risk. When you switch banks, it resets your financial history with them, erasing any prior evidence of consistent financial behavior. The result? Your lender may view this as a red flag, potentially signaling financial instability or a perceived lack of commitment. You see, banks prefer that borrowers maintain the same accounts during the mortgage application process because it provides them with a consistent track record of your financial transactions and behavior. Now, consider your credit score, a crucial piece of your mortgage approval. Changing banks involves the closure of your existing account and the opening of a new one, actions that can have implications on your credit rating. Even if marginal, shifts in your credit score can affect your interest rates, or worse, result in a denial of your mortgage application altogether, especially if your credit was already borderline. There is also the question of timing and documentation. During the mortgage approval process, lenders scrutinize every transaction with a fine-tooth comb, establishing a comprehensive understanding of your financial situation. When you switch banks, you introduce a new layer of complexity. Your lender needs updated records from the new bank, potentially leading to delays as you await the processing and availability of statements and records. Such delays could mean losing the chance at securing your loan under the original terms, as interest rates are subject to change based on market conditions. Moreover, switching banks could interrupt your ability to maintain necessary bill payments and automatic withdrawals, casting further doubt on your financial reliability. It's crucial for lenders to see that you can honor existing financial commitments without fail. Disruptions caused by changing accounts can inadvertently put your approval at risk by painting an unclear or even negative picture of your financial habits. On a seemingly innocuous note, the loss of loyal customer benefits in your previous bank and the potential fees associated with prematurely closing an account can sneak up on you. While you may not initially feel the direct impact of these additional expenses, over time they can alter the overall perception of your financial strength in the eyes of your lender. So, what steps can prospective homeowners take to navigate these treacherous waters successfully? Firstly, avoid making any significant changes to your financial situation during the mortgage application process. Once your application is submitted, the best course of action is to keep everything as consistent as possible. If a bank switch is absolutely necessary, inform your lender immediately. Transparent communication can sometimes work miracles, as your lender can provide guidance or special considerations that may only require additional documentation rather than becoming a deal breaker. Keeping documentation meticulously organized can alleviate some of the stress associated with a bank switch. Make sure you retain copies of old bank statements to easily provide them when requested. Consistency and preparedness in your financial documentation can go a long way in smoothing over potential anxieties from the lender's side. Lastly, engage a mortgage consultant or financial advisor early in the process. Their expertise and advice can prevent you from making uninformed decisions that could jeopardize your mortgage approval. While the idea of switching banks may appear benign, doing so amidst the mortgage approval process is fraught with potential pitfalls. With the stakes so high, it's crucial to tread carefully, showing lenders the financial stability and predictability they value. Stay proactive, communicate openly, and remember that the smallest financial choices can have the greatest impact in the grand scheme of homeownership.